It is about the nominal GDP and real GDP. Nominal GDP measures the market values of all currently produced final goods and services at current market price. And this nominal GDP is not useful to compare economic performance among different periods because it is often affected by a rise in price or inflation. Even though there is no production, if there is a rise in price of goods and services, since it is measured by current market prices, there is a rise in the nominal GDP. Hence, it is not useful to compare economic performance among different periods. But the real GDP measures the market value of all currently produced final goods and services at constant price. This is a better tool used to measure economic performance among different periods because it avoids the problems of inflation or rise in price using the consumer price indexes. Real GDP rises only when the amount of goods and services or the outputs increases, or whereas the nominal GDP can increase simply either with a rise in output or with a rise in price. That means we are not certain whether there is economic growth or not using the nominal approach, but the real GDP avoids this problem using the consumer price index. Mathematically, real GDP is calculated by dividing nominal GDP for the consumer price index multiplied by 100. Suppose the consumer price index of the year 2001 and 2002 were 10 and 50 respectively, and the nominal GDP of the year 2001 and 2002 were 1 billion and 2 billion birr respectively. Now we are going to calculate the real GDP of these 2 years, 2001 and 2002. So the real GDP in the year 2001 is the nominal GDP of the year 2001, which is 1 billion birr, divided by the consumer price index, which is 10, multiplied by 100, and this will give us, when we cancel 0 for 0, then we left with 10 billion birr. So the real GDP of the year 2001 is 10 billion birr. Similarly, we can calculate the real GDP of the year 2002, and it is calculated by dividing the nominal GDP of the year 2002, which is 2 billion, divided by the consumer price index in the year 2002, which is 50, multiplied by 100. And when we cancel 0 for 0, by 5, 1, by 5, 2, and then we left with 4 billion birr. So the nominal GDP increased from 1 billion birr to 2 billion birr, but the real GDP declined from 10 billion birr to 4 billion birr. Now let's see the way of calculating the economic growth rates using the nominal approach and the real approach. So if you do have the nominal GDP of 2 consecutive years, you can calculate the economic growth rate of the last year. So the economic growth rates in the year 2002 is the nominal GDP of the year 2002 minus the nominal GDP of the year 2001 divided by the nominal GDP of the year 2001 multiplied by 100 will give you the economic growth rate in the year 2002. So the nominal GDP of the year 2002 is 2 billion birr minus the nominal GDP of the year 2001 is 1 billion birr divided by the nominal GDP of the year 2001 is 1 billion birr multiplied by 100. And then 2 billion minus 1 billion is 1 billion over 1 billion multiplied by 100. So the economic growth rate using the nominal approach is 100%. But this 100% increase in GDP is not associated with increase in productivity. It is associated with a rise in price of goods and services, because the CPI is 5 times and the nominal GDP is twice. So this is the wrong way of calculating the economic growth in an economy. The right way of calculating the economic growth rates is the real approach. Using the real approach, as I told you earlier, the real GDP of the year 2001 is given. We calculated the real GDP of the year 2001, which was 10 billion. And we calculated the real GDP of the year 2002, which was 4 billion. Now, using the real approach, we can calculate the economic growth rates. So the economic growth rates of the year 2002 will be the real GDP of the year 2002 minus the real GDP of the year 2001 divided by the real GDP of the year 2001 multiplied by 100. So the economic growth rates in the year 2002 will be 4 billion minus 10 billion divided by 10 billion multiplied by 100. This is minus 6 billion for 10 billion multiplied by 100. And when we cancel 0 for 0, this is minus 60%. So using the real approach, the economic growth tells us there is a decline in economic growth rate by 60% from the previous year, the year 2001. Now, let me give you exercise. Using the following information, the consumer price index of the year 2011 is 100 birr, and the year 2012 is 200 birr. The nominal GDP in the year 2011 is 50, and the nominal GDP of the year 2012 is 150. The question is calculate the real GDP of the year 2011 and 2012, and the second question is calculate the economic growth rate of the year 2012. Now, let me give you 3 minutes. % in the year 2012. Now let's see the problems of measuring GDP and GNP. One of the problems of measuring GDP is unavailability of data. It is difficult to get perfect information or data from different resources. The other problem of measuring GDP is the barter transaction. The barter transaction is trading for goods. For example, most of Ethiopian farmers are engaged in the barter transaction. They sold their outputs using another output. For example, wheats for teff and teff for goats and the like. The other problem of measuring GDP is double counting. There is double counting in measuring GDP. If we all add the values of the intermediate inputs and the outputs together, there is double counting, and it overfigured the level of GDP. The other problem is the maintenance of accounts. It's difficult to maintain different accounts. Another problem of measuring GDP is production for self-consumption. Products which are produced in home and consumed in home are not included in measuring GDP, but they are economic activity. For example, baking bread, injera, wood. All these are products produced in a house and they are consumed in a house. So they are not included in measuring GDP. This is one of the problems of measuring GDP. Outputs produced in the informal sector are not included in estimation or measuring GDP. The informal sector is categorized into two, called the legal and illegal. The legal informal sector constitutes touch production, local areca production, Talla production, all these are legal but informal sectors. They are called informal because they are not subjected to tax or registered for tax by the Inland Revenue Authority. So these are outputs that are not included in estimation of GDP of a country. The illegal informal sector constitutes drug dealing and prostitution. So they are not included in estimation of GDP because they are categorized under the informal sector. Another problem is transfer payments are not included in measuring or calculating GDP. These transfer payments are payments made by the government for those individuals who cannot offer service for the money they get from the government. For example, pension payments are transfer payments. Unemployment insurance compensation allowance is transfer payment. So these payments are not included in estimation of GDP of a country. The other problem is windfall gains, incomes from smuggling, picking pockets are not included in estimation of GDP because they are not productive transactions. The value of second-hand goods is not included in estimation of GDP because it is not current production. Now let's see the GDP End Income Distribution. GDP can measure the gross level of outputs produced in an economy. The aspect of the economy that GDP does not measure is distribution of income across different households. We don't know the share of the outputs or the income share among the society, but it measures the total value of outputs produced in an economy. So this is the major problem of measuring economic performance using GDP. GDP is a better tool used to compare economic performances or used to measure the level of economic performance of a country, but it is not the best tool used to measure economic performance of a country. A production of few individuals or groups might increase the GDP of a country without improving the living standard of millions. So this is one of the major problem of measuring GDP because it cannot measure distribution of income across households. Now let's see the other social accounts. The net domestic products at market price is calculated by deducting depreciation from the gross domestic product at market price. The net national product at market price is equal to the GNP at market price minus depreciation. GNP at market price equals to the GDP at market price plus the net factor income. Then in other ways we can calculate the net national product at market price by adding the gross domestic product at market price in the NFI minus depreciation, because the GNP is the sum of the GDP and the net factor income. So the net national, in other ways, we can calculate the net national product at market price by deducting depreciation from the GDP and adding the net factor income. GDP at market price minus depreciation is the net domestic product at market price. So we can calculate the net national product at market price by adding the net domestic product at market price and the net factor income. The GDP at factor cost is calculated as GDP at market price minus indirect business tax plus subsidies, and the GNP at factor cost equals to the GNP at market price minus indirect business tax plus subsidies, or the GDP at factor cost plus the net factor income. The net national product at factor cost, NNP at factor cost or national income, is NNP at market price minus indirect business tax plus subsidies. The other social account is personal income. Personal income is calculated as national income minus indirect business tax, corporate profits, social insurance contributions, net interest, and we will add dividends, government transfers to individuals, personal interest income. Finally, the personal disposable income equals to the personal income minus personal income tax. This is households' income left in their pocket after paying income tax for the government. Now let's illustrate using the following numerical example. Here the total consumption expenditure is 30 million birr. Government expenditure is 10 million birr. Gross domestic private investment is 8 million birr. The value of export is 4 million birr. And the value of imports is 6 million birr. And the depreciation is 3 million birr. Indirect business tax are 7 million birr. The factor income received from abroad is 12 million birr. And the factor income paid is 9 million birr. And the total subsidies in an economy is 2 million birr. From this, we can calculate the gross domestic product at market price by adding the consumption expenditure, government expenditure, the gross domestic private investment, and the net export. The net export is calculated by deducting the value of exports for the value of imports. That means the net export X minus M equals to import is 6 million birr and export is 4 million birr. That means 4 minus 6 is minus 2. So the gross domestic product, the GDP, is total consumption expenditure plus the gross domestic private investment plus government expenditure plus the net export, which is the difference between export and import. So from this, the gross domestic products is calculated by adding the total consumption spending plus the gross domestic private investment plus government expenditure plus the net export. The total consumption expenditure is 30 million plus the gross domestic private investment is 8 million plus government expenditure is 10 million, and we calculated the net export, which is minus 2. Then this will give you 30 plus 8 is 38, 38 plus 10 is 48, 48 minus 2 is 46. 46 million birr is the gross domestic product. Now, once if you get the gross domestic product, it's so simple to calculate the gross national product at market price, GNP at market price. The GNP at market price is the gross domestic product at market price plus the net factor income. And the net factor income, NFI, is calculated by deducting the factor income paid from the factor income received. So the factor income received is 12 million and the factor income paid is 9 million, and then the net factor income is 3. So the gross national product at market price will be, we calculated the GDP at market price, which is 46 plus the net factor income is 3, and then the gross national product is 49. Now, let's see the other social account calculations. We calculated the gross domestic product at market price, which is 46 million. And we calculated the gross national product at market price, which is 49 million. And the other means of calculating the GNP is by adding the NFI with the GDP at market price. The GDP at factor cost from the given information is the GDP at market price, which is 46 million, and the indirect business tax is given, which is 7 million, and the subsidies is 2 million. So the gross domestic product at factor cost is 41 million birr. The GNP at factor cost is equal to the GNP at market price minus indirect business tax plus subsidies, and this is the GNP at market price we calculated earlier, which is 49 million minus the indirect business tax is 7 million plus 2, which is 40 million birr. The GNP at factor cost, in other ways, we can calculate by adding the GDP at factor cost, which is 41 million, plus the net factor income, which is 3 million. Then 44 million birr is the GNP at factor cost. The net domestic product at market price is calculated by deducting depreciation from the GDP at market price. And we calculated the GDP, which is 46 million minus 3 million. Then 43 million birr is the net domestic product at market price. The net national product at market price is the GNP at market price minus depreciation. And we calculated the GNP at market price, which is 49 million, and depreciation is given, which is 3 million. So the net national product at market price is 46 million birr. The net national product at factor cost or national income is the net national product at market price minus indirect business tax plus subsidies. And we calculated the net national product at market price, which is 46 million, and the indirect business tax is given, which is 7 million, and the subsidies is 2 million. So we left with 41 million. This is the national income. Students, now let me give